Welcome to session 7 of the 30 session workshop series that we've started. And in this session, we are all going to study about unit economics. There are certain terms like CAC, customer acquisition cost, lifetime value, churn rate, and MRR. There could be ARPU and several others that we're going to study, right? We'll start with a hook. A startup that spends 500 rupees to acquire a customer who pays 200 rupees per month and churns after 2 months, which means he has contributed only 400 rupees in terms of revenue. Is this a good business? I think the answer is very clear. So what is CAC? The true cost to bring one customer in the door. LTV, what that customer is worth over their lifetime. And there's a ratio that we need to calculate. LTV is to CAC. And if it is greater than 3x, this is what every investor actually first checks. Churn is the silent killer of subscription businesses. Let's start with a recap. In the last session, which was all about pricing strategies, we dealt with 4 frameworks, and they all give a zone. There was cost plus pricing, and that you have to consider only as the floor. 99 rupees was the example that we took from Study AI. Value-based pricing, or it's all about the ceiling. So maybe between 149 to 199. There was a competitive pricing, which talks about the context. Together, the test zone is 99 to 199. This is where you have to test it, and whichever gives you success, fix on that for some period. The second one is value-based, is the most important, powerful, pricing that we actually saw. What would it cost my customer without my product? That's the ceiling. In case of Study AI, the tutor, if you look at the alternative, 400 to 600 rupees per month. So you may have a room for, keeping the price from 129 to 149. Imagine if there's a 10% increase, take it as 129 versus 99. What you're generating the revenue is 36,000 per month. You just see what happens over the year. So which means a 10% price increase costs nothing extra and adds thousands in profit. Most founders underprice by 20 to 30%. So today we are going to actually study about something called the unit economics, right? We will see, and you can ask this question, is each customer relationship actually profitable over the lifetime? Right? And once the hook is established, we will start with the customer acquisition cost. We'll move on to understanding the lifetime value. This is all going to be some math that will be involved, and the ratio that I discussed. And then, of course, we'll end with MRR, ARR, and net revenue retention. So what will happen towards the end of this entire session, you'll be able to evaluate the ratio, that is LTV, is to CAC versus the 3x benchmark. You can very easily calculate monthly and annual churn, and you can build an MRR, ARR dashboard. The answer is very terrible. It's simple, and it's a terrible business because you're actually losing. So founders won't know until the money run out. So there's something that you need to actually know. Let's take the example. And this will help each and everybody watching this. The customer acquisition cost, the cost that's acquired, that's incurred to acquire one new customer per month, let's say is 500. The monthly revenue per customer, the customer contributes 200 rupees per month. The customer's lifetime is 2 months, which means customer is there for 2 months. For 2 months, the customer has contributed. So the revenue generated per customer, in this case, is 400 rupees. Okay. And the gross margin is 60% of the revenue, which means the lifetime value after the margin is 240. So what are you seeing? You are spending 500 rupees to acquire that customer. Your net, which is LTV minus CAC, is very simple. It is 260 rupees. Because after margin, the LTV is just 240. You're subtracting the 60% gross margin for 400. It's actually a loss. And if you take the ratio, LTV is to CAC, which is very simple, 240 divided by 260, you will get 0.48x. Very simple. It's destroying the 260 of the value per customer. Right? So, what's the fix? And let's do randomly. First one is, let's reduce the CAC. Cut CAC from 500 to 200 via organic channels. Then the LTV is to CAC. It goes from 0.48 to 1.2x. Better, but it's still not 3x. Let's do another thing. Let's increase LTV. Raise the price from 200 rupees to 300 rupees. Not always common, but you may try this per month. And let's assume the churn remains the same, which means the customer will be there only for 2 months. Customer will contribute 600 rupees as revenue. So LTV will rise to 360. Okay. So LTV is to CAC will then be 0.72 times. Still broken. Let's do another thing. Let's reduce the churn. So improve retention from 2 months to 6 months. Now the customer is actually staying longer. But your LTV actually, so let's take the LTV. LTV is 200. We're keeping the monthly revenue as 200. And 200 multiplied by 6, which is 1200, multiplied by 60%, okay, will be 720. Right? This is the LTV. So LTV is to CAC now will be 1.44x. That's getting warmer. Okay. But let's apply all the three. Let's reduce the CAC from 500 to 200. Let's increase the price from 200 to 500. And obviously, let's reduce the churn. So 6 months lifetime. And when you do all the things together, you will find 1080. So LTV is to CAC is 5.4x. This is called the business. Just see if this is working. So unit economics is not one number. It's all about relationship. What we did was relationship, and we randomly applied so many things. So it is the relationship between CAC, LTV, and churn, and each lever affects the others. Let's understand part 2, which is the customer acquisition cost in detail. Very simple question. What does it actually cost to get one customer? This is the question that CAC answers. Okay, not just the ad spend, the true cost, including every rupee that goes toward getting paying customers. That will be part of the CAC formula. Okay, and the CAC formula is very simple. Take the whole sales and marketing spend and divide by the new customers acquired for the same period. If it is month, do it for month. If it's for year, do it for year. But let's start with a month, right? Let's assume in the CAC, the paid ads, Google, Meta, LinkedIn, everything is all linked, and that costs 12,000 rupees per month. The salaries that sales team get. But here, in case of the study AI, there's nothing. So let's assume it's 0. So at least some amount you've saved here. Marketing tools and software, 800 rupees per month. Content creation for acquisition. Now this is more. This is 3,000 per month. And referral payout, program payouts, 500. Somebody refers to you, one new customer, you're actually paying. Right. So there's a referral program, 500 rupees per month. So the total sales and marketing cost is 16,300 per month. Let's see how many customers come. But on the other hand, let's first look at what is not included in CAC. It's very simple. The product development cost does not come because it goes to the COGS or operating expenses. Customer support costs It's a part of the cost to serve. Then general admin or accounting, it's an overhead and which means the operating expenses, and it's not acquisition. Then product infrastructure, it's all, hosting, servers, everything. So that's a part of the COGS, or sometimes it may go as part of the OPEX as well. Okay. So let's take the example, right? So in month 6, the new customers acquired is 220. What was the spend to get these 220 customers? 16,300. Okay. So the paid CAC was 74. Just divide 16,300, right, by 220. You get 74 rupees. What's the price that you're selling the product? To one customer is 99. So obviously CAC is much less, right? And we're not spending anything. It's all organic, right? Then organic new customers came 180. Now in this case, right, it is 40 rupees. So you can do a blended one. You can just combine, say, 16300, and you can actually divide by 220 and 180. You get the blended CAC as 40, much less. Let's also understand the LTV, the lifetime value, what one customer is worth over time. And let's first calculate the simple LTV. A simple LTV is equal to the average revenue per unit that you get, right, which is 99 rupees in this case, multiplied by the gross margin percentage. And then you divide it by churn rate. Okay. There's a simple relationship between lifetime value and churn rate as well. Okay. And both are inversely proportional to each other. So churn rate will be equal to 1 over LTV. But there's a way to calculate, there's a method to calculate churn rate. Okay. You first take how many customers are lost in a particular month, and then divide by the last month, customers that were left. And that's how you will actually calculate the churn rate. So for study AI's, month 6, the average revenue per unit is 99 rupees. The gross margin percentage is 92.9% in 6th month. The monthly churn is 3%. Okay. So very simple, 99 into 92.9%, and you divide by 3%, you get 3065. This is the simple lifetime value of that one customer. But let's do it another way, the more accurate manner. So LTV is equal to, you take the revenue minus COGS, okay, per customer. This is also the contribution margin, if you remember. You take the contribution margin and divide it by churn. The contribution margin is 92 because 99 minus 7 is 92. And then you divide by 3%, you get 3067. So quite closer, but that's the value. Okay. How churn rate destroys or builds LTV? Same product, same price, and you can do it. But before even I explain to this particular table, it would be great if I explain to you, this part, right? This is the churn, the silent killer. So why 5% monthly churn is equal to 46% annual churn? Okay. So let's take the simple example which I gave you. Monthly churn rate is equal to customers lost divided by customers at the start of the month. Let's start with 1,000 customers. So in month 1, if you have 1,000 customers and if you have a churn rate of 1%, which means your 10 customers are lost because 1% of 1,000 is 10. What you're left with is 990. Now imagine if this increases to 3% the same month, then you have lost 30 customers, which means you're left with 970. If it is 5%, then of course 50 customers lost, so you have 950. And 10%, you're left with 900. Please remember this calculation is compounded. Okay. So every time the base will not remain 1,000. Okay. Now imagine you reach month 3 and there's a churn that's actually happening. Let's assume the churn rate was 1%. right, what you'll be left is 970. Because your previous month's value, the second month, it won't be 1,000 because you've already lost 10 customers in month one. So the base will start from 990. Okay, and from there again, if you remove 1%, so which will be 9.90, and you will be left with 970. Think in this manner. If it is 3% churn, of course, you'll be left with 912. If it is 5%, you'll be left with 857. If it is 10%, 729, because it's getting compounded. If you reach at the 6th month, half yearly, at 1% churn, you're at 941. If it is 5%, you're left with 735. And if it is 10%, 531. Okay. If you do the entire year, 1% churn, you're left with 886. And if it is 5% churn, you're left with 540. Okay, which means how many customers lost? 460 customers out of 1,000. Okay, so what is the percentage? The percentage is very simple. 446, because 460 divided by 1,000 into 100 will be 46%. So therefore, 5% monthly churn is 46%. Right? So it's very simple. Okay, we'll come back to this slide. But let's come back to this table to understand this LTV concept. So how churn rate destroys or builds LTV, same product, same price. Now you have understood. And here we are taking the base as 100. Okay. Monthly churn 1%, customer lifetime is 100 months. Similarly, for 3%, it's 33 months. 5%, it's 20 months. 10% is 10 months, right? And look at the annual churn. In 1%, it's 11.4, because as your churn increases, right, your annual churn actually increases like anything from 11% to 89, right? You look at the LTV. The LTV at 1% annual was 9,200, but if it increased to 5%, you drastically reduced your LTV to 1,840. And from 1%, if it increased to 20%, you're left with only 460. Look at the situation from exceptional to broken. This is very important, and every founder must note this. Let's calculate the ratio that really matters. The investor's first question. So LTV is to CAC, the lifetime value, divided by customer acquisition cost. If it is below, right, 1 time, that is below 1, if you say, or 1x, every customer you acquire destroys value. We've already seen, right? You lose money on every one. Okay, so stop scaling first, fix the model. But if it is between 1x to 3x, decent. But what happens is high execution risk. So understand the root cause, improve before raising any capital. If it is 3x to 5x, this is healthy. The minimum investor wants to see at the seed or series A round. You must have heard these terms while raising capital from an investor. So maintain and scale carefully. But if it is more than 5%, and let's say till 10%, it's really strong, it's competitive. Okay, it indicates that the pricing power or low CAC, it accelerates acquisition while ratio holds. And if it is above 10%, it's really, really exceptional. It's rare at scale, often signals a lot of untapped pricing room, right? Now you can do this math. So 3067, what you got here, let me just go back, right, from the LTV. And if you divide it by rupees 40, you get 76.7 times. Extraordinary for a digital product. So the metric is very simple here. If you take the 6th month, the paid CAC was 74 and the blended CAC was 40. The LTV, simple LTV, was 3067 and the ratio was 41.4, which was paid, to 76.7 blended. Both figures are exceptional. The bottleneck is not unit economics. It's the awareness. Okay, which means that most potential customers don't know that this particular company actually exists. Okay. So how do you reduce the churn? We've already seen this particular table. Onboard customers fast, value in less than 7 days. You know what happens? It reduces the 7-day, a 30-day churn by 50%. There's another catch. Try to build them for an entire year. And that's why in subscription models must have seen this one very common thing. Okay, they take money upfront for the entire year so that you don't leave. Because what happens? Commits the customer and eliminates monthly churn rate. Customer has no longer choice to actually leave. Regular engagement, push relevant content, right? That's very important. Re-engage before they leave. Usage drop is predictable 30 days before churn. Exit surveys. Understand why they leave before trying to fix it. So study AI's churn advantage. Digital product, no subscription friction. Exam deadlines create natural urgency to say. Then 3% monthly churn, which is equal to 30.8% annual. The target year should be 2% monthly, which will then be the monthly churn will reduce, the annual churn will reduce to 21.5% via some annual subscription launch. Let's now understand the terms MRR, ARR, and net revenue retention. NRR. So MRR is very simple. It is monthly recurring revenue. How do you calculate monthly recurring? Recurring means repeating. The same customer is paying you again and again because buying. Active customers multiplied by the average revenue per customer per month, ARPU, right? So MRR is made up of 5 components and you have to track all of them separately. First, the new MRR, okay, which means from brand new customers this month, 21,780, let's say. Expansion MRR. So from the same customer, that's existing customers who upgraded. So you use the term expansion. Contraction, the existing customers might have taken a lower version of your product, downgraded. So 990. You've lost, obviously, here the revenue. Churned, some of them churned, right? So from customers who cancel, that is 3,564. When you calculate the net new MRR, it's just the addition of new MRR and expansion, and to subtract the contraction and the churned, you're left with 21426, right? So annual recurring revenue, if to calculate, just take the MRR multiplied by 12. Let's take the example. Study AI's month 6, okay, 1200 downloads multiplied by 99. We've already seen this is how we actually started. 1,18,800 is the revenue. There's another thing that we are adding, that's annual subscription. Let's say there are 80 such subscriptions, and this is annual. So the price is now 799, okay, by 12, and you can take it as 5327. Very simple. And let's say tutoring, if there are 20, and then 499 is per, per tutoring cost. So the revenue, so 9,980, and the overall monthly revenue rate is 134107. Okay, and if you have to calculate, let's say the NRR, the net revenue retention, which is the holy grail we call. Very simple. Take the starting MRR plus the expansion, subtract the contraction and churn, and then divide by the starting MRR and multiply it by 100. It's as simple. So take the net new MRR, divide by the starting one, and multiply it by 100. Okay. So what you get is 99.7%, much closer to 100. If NRR is more than 100%, which means existing customers spend more each month, right? If it is less than 100%, churn is winning. And of course, we see in this example that there's churn. So always try to have above 100%. So why NRR matters more than the new MRR? Because a company with NRR of 120% grows revenue even with 0 new customers. A company with NRR of 80% must constantly replace churned revenue before it can grow. Study AI for year 2, NRR above 105%, via annual subscription. If that's the target, it'll be great. Okay. So let's talk about the CAC payback period, because you've invested so much to get one customer. When will you get that money back? Okay, another way you can ask this question: how long until a customer pays for themselves? And the formula is very simple. Take the CAC, divide by monthly revenue per customer, and multiply it by gross margin. Just work it out yourself. Okay, it's very simple. So take the example of the CAC, which was organic, right? And we got the value as rupees 40. What is the monthly revenue rate? In that case was 99, and the gross margin was 92.9%. What you're getting is 0.44 months. So which means 44% of a month. The month has got 30 days. So 44% will be 50% is 15 days. So obviously it'll be closer to 12 or 13, right? Precisely if you calculate, it'll be 13.2. So what does this mean? This means that after 13 days, in case of study AI, right, the customer is profitable. This is very simple, right? Every month after that is a pure LTV. Okay, so there are certain business types, and let's understand the payment benchmark. If it is a consumer digital or SaaS, if it is it's usually less than 12 months, which is good. If you're able to get within 6 months, right, you can recover within 6 months. So this is great. And why this is important? Low CAC plus high retention is a fast recovery. But in case of B2B SaaS, because you get very larger contracts, so obviously the recovery will be a little longer time. If it is less than 18 months, great, good. But less than 12 months, that's great. Higher CAC but larger contracts. In case of D2C or e-commerce,
It's 2 o'clock.
it's less than 6 months, less than 3 months, great. Low margins need fast payback. In case of marketplaces, less than 24 months, very hard. Network effects make long payback worth it. Study AI was exceptional. Less than a month, 1.4, what we saw, right? So what you learned in this particular session is very simple. CAC, if you have to calculate all spendings in marketing and sales that you do and divide by the new customers that you get. In case of study AI, when they spend 16,000 rupees around, they got 77 per customer. Okay, but it was organic, and when they combined the entire thing from the blended, we call it as blended. Okay, so 40 rupees was the CAC. Okay, LTV is very simple. Contribution margin per customer and divided by monthly churn. So 92 divided by 3 again, 30367. Churn is the single most powerful lever in LTV. 1% less churn is equal to 30%, 33% more LTV. And then the ratio, if it is more than 3 times, this is the minimum that we expect, which means 76.7x is exceptional. Okay, 5% monthly churn is 46% annual. Never underestimate it. Monthly churn compounds silently, and therefore it's a killer as well. That's what we were discussing. Fix retention before scaling acquisition. Annual subscriptions are the fastest churn reducer. So what you're expected to do is take this as a challenge, calculate your CAC, right? Take the total sales and marketing spend for the last month and divide by new customers acquired. Those who are not into any business, just do a simple accounting, take some numbers and go ahead. The second thing that you need to do is calculate your average revenue per customer per month, ARPU, and multiply it by gross margin. Then what you do is estimate your monthly churn rate. Okay, how many customers lost a particular month, and you divide by the start of the month, the customers, at the start of the month. Then you calculate the simple LTV, ARPU into gross margin percentage divided by monthly churn. Then you do the ratio. and see whether it is above 3x. If not, which lever is easiest to move? Do you want to lower the CAC, raise price, reduce churn, or do a mix? Then lastly, calculate the MRR. If you have existing customers, track new expansion and churned MRR separately. There's a template, which is T6, and the formula already there, right? You can actually use it. I'll also put it in the link. So what is the tip? Unit economics tip. Fix churn before scaling acquisition. That's the tip. Every 1% improvement in monthly churn rate roughly doubles your LTV over 24 months. It is the highest ROI improvement available to an early stage founder. In the next session, we will definitely talk about the time value of money and compounded growth, right? Very simple. So which means that why 1,000 rupees today is worth more than 1,000 rupees next year. Because over a period of time, the same amount will actually depreciate. Session 7 is complete. You can now present a full unit economics dashboard, and all the best. Thank you so much for watching. Do like and subscribe.